The house that you guys are looking at behind me, we have actually stopped by several times before on the channel, and this is yet another example of the never-ending listing, guys. This home has been listed for rent for literally 6 months, and I am not joking. They listed it for rent back in May of this year for $35,000. At some point they cut the price to $25,000. It's still available. But one thing that's different this time, I notice, is that there is no real estate sign here anymore advertising that it's for rent, and there's cars in the driveway, so maybe the actual owners or someone's here finally enjoying the house for a little bit while it's up for rent. But one thing that we've kind of covered on the channel before that I want to hear from you guys is, do you think things like this should be allowed? You know, I want to hear your opinions. Do you think it should be allowed that rentals like this can sit empty for 6 months without a tenant? Do you think the government should get involved? Should they force people to rent it to someone at fair market value? Like, what do you guys think that they should do? Because clearly we have a housing affordability crisis on our hands. And I've heard a lot of people say in the comments, you know, they should ban all corporate investors from buying real estate right now because, you know, they're buying up everything, which has caused the prices to go up, which is true, guys. These institutional investors have caused prices to skyrocket, you know, taking inventory off the market for regular people and pushing up prices for what is left for the average Joe. Do you guys think that the government should get involved and do things like force people to rent homes like that, you know, for the real price, which is probably like $8,000 to $10,000 a month? I know that sounds crazy, but for a house like that would probably rent for that price around here. Do you think they should do stuff like that? Do you think that they should ban institutional investors from buying real estate right now since we have this housing crisis? Like, what do you guys think? Let me know what you think is the solution to this. You know, when I was answering some comments yesterday, I even had this idea that just kind of dawned on me that, you know, instead of maybe doing something drastic like banning investors, maybe one thing that they could do that would be maybe a good trade-off, a good middle ground, is similar to what the HomePath program does. And if you guys aren't familiar with that, HomePath allows regular people the chance to buy foreclosure listings for the first 30 days before any investors can bid on the property. And so the listings on HomePath stay listed for 30 days, and so owner-occupants get first dibs on every single listing on that website before any investors could buy it. And I think some kind of rule like that right now could be a good mix when it comes to figuring out this housing affordability crisis. Because imagine, guys, if every single listing in the country was not available to investors until owner-occupants have had a crack at it for the first 30 or even 60 days of listing, then that gives everyone a fighting chance, right? Like, you don't have to worry about being outbid by a cash investor. You might be outbid by somebody who actually wants to live in the house. But now what you've done is you've narrowed down the pool of competitors to people that are looking to actually live in the house, and you have to buy the house under your own name, no LLCs, nothing like that, and you have to show proof of residency after the closing is finished and prove that you have moved into the house. Like, it needs to be something that serious. That's what I'm thinking, in order to get things back to normal. Because without something like that in place, I think you guys are right. You know, the prices of real estate are never going to get fully under control just because there's too much demand for the same housing. And you know, if a house sits on the market for 60 days and, you know, buyers in the area have determined that this is not worth buying, then it's perfectly fair game for an investor to go ahead and buy that property. And I think just that one act alone could easily put things into the real world again when it comes to prices and people being able to buy at these current interest rates. And I'm not saying they should lower the interest rates. They should keep the interest rates where they are. We need that in order to fight inflation. But what they would be doing is completely killing demand for housing even further, which means that people who are left, who are going to buy, are going to be able to get good bargains on properties and be able to essentially buy them for what they're actually worth. So let me know if you guys like this idea, basically giving owner-occupant borrowers first dibs on all properties, not just foreclosures from HomePath, but all properties, every single listing must give an owner-occupant the first right of refusal, essentially, when it comes to buying a property, and investors get to pick it up 30 or 60 days later. I mean, I wish I worked for Congress, guys. I would pass this for you in a heartbeat. I think something like this is much needed right now, but let me know what you guys think. And the reason I wanted to bring this up today is because talking about the government getting involved, in Canada, the banksters are basically trying to prevent huge mortgage defaults, guys. People in Canada are in such big trouble right now, and to give you an idea of what's happening is basically the Canadian banks are trying to ease the burden for current homeowners who can't keep up with the rapid rise in interest rates by extending their mortgage amortization and, in some cases, adding their unpaid amounts into the loan principal balance because they can't afford the new rate when it comes time to refinance. Because remember, a lot of people in Canada have very short-term loans that need to be readjusted every few years. And the reason why people in Canada are in trouble right now is because now that the federal funds rate in Canada by the Bank of Canada is 3.75%, just like it is here in the US, this puts 50% of borrowers who have a variable rate mortgage right now into trigger rate territory, which basically means the amount that they're paying right now per month is only enough to cover the interest and is no longer enough to cover any of the principal, and that's against the federal law in Canada. So the lenders and the banks are basically forced into a corner right now. And what they need to do is they basically have a few options. They can raise their monthly payment, okay, which probably it's going to happen to a lot of people. They can require a lump sum payment to basically have a chunk of that go towards the principal that needs to go towards it by law, or they can let borrowers slip into negative amortization or reverse amortization for a period under the rules set by the banking authorities and mortgage insurers. And basically how this works is like this. Negative or reverse amortization occurs when mortgage payments aren't sufficient to cover interest due and the excess amount is added to the principal owed on the loan, a procedure that could leave homeowners with a larger outstanding balance at renewal. So basically, they're delaying the inevitable. And as we go deeper into this recession, as interest rates continue to rise into next year, and they're saying that once the Bank of Canada interest rates get to 5%, that basically they're going to be in emergency territory to the point where the government's going to have to announce some sort of help measure to assist distressed borrowers. That's how bad this is, guys. And right now, about 16.6 million mortgage borrowers in Canada are going to be looking at hitting this trigger rate very soon, which means a ton of people, we're talking over 16 million households there, are going to be in trouble with their payments and either looking at a lump sum payment, you know, here, you need to put up all this cash, surprise guys, or you need to put additional debt onto your principal amount owed on the property, or you need to increase your monthly payment. So to me, none of those options sound great, especially when you can't afford any of them. And I want to get into a real life example from somebody over there that this actually happened to. But to put this into perspective, guys, the big takeaway from this is that these bankers are doing everything possible to keep the financial burden on you as the homeowner. So don't think that this is just something exclusive to Canada. This is happening over there right now because, you know, the real estate market is in a huge bubble. But one thing that's similar and that could happen here in the US or any other country is that things are getting so bad that they're trying to do any type of games and shenanigans possible to keep people from defaulting on the loan. And if that means requiring you to pay more for now or putting extra debt on the property to keep you in it a little while longer, all they're doing is delaying the inevitable, essentially. They're keeping people in homes that they really can't afford, and what they're gonna do is they're going to make this bubble so massive that when it does pop, there's gonna be no way it's not gonna be a depression. So a lot of these people in Canada are going to be in huge trouble from this, and basically, if they do get any kind of help with this financially, it's just going to delay the inevitable for them. They're just going to get to the point where Now it's even more expensive. I really can't afford it, and I'm gonna be forced to sell. And there was a story sent to me by one of my channel members, Nick. Thank you for sending me this, of somebody in Canada who literally just went through this, guys. But their story is a little bit different. They had a hard time paying the bills during the pandemic. You know, things are shut down, can't work and make money, so this person needed money. So what he did is he took a second mortgage on his house. That wasn't enough. Ended up taking a third mortgage on his house. That wasn't enough. So this guy started taking out a ton of debt on his property because property values in Canada went up in the order of about 60% in just 1 year. It was insane, even crazier than here in the US. Now that property values are starting to go down, and his mortgages he took out on the property are due, the guy can't pay. So what are you gonna do now? He's forced to sell. And by the way, guys, I'm walking here on Alton Road right now for the very first time. If it's too noisy, let me know in the comments, because I've been avoiding walking out here because there is a lot of traffic. But if it's not too bad, I'll do more walks along here because there's a ton of things to see that you guys haven't seen yet. Check this house out. It's for sale, totally original, looks like, pretty bad condition, probably a whole nother gut renovation project right here. This is another really common type of house I'm starting to see around here, are these old dilapidated homes that basically are a total gut job, and they're just selling these properties for the land value. They want $3.2 million for this place because it's a double lot and you can either build one huge house or split it into 2 lots. It's crazy that this amount of land is going for that much money. So basically, this guy was extremely bullish on the housing market in Canada and thought that values could never go down, and people kept telling him, hey, it's gonna crash, it's gonna crash. He didn't want to see that, and when it did crash for him, it went down so fast that now the guy can't pay anymore and he's forced to sell. And basically, this is the only option out of this, guys. He's losing his home. So I don't know if this guy's gonna be homeless or if he's going to be able to afford to live somewhere else after selling the house. It sounds like he's not really gonna have any money left over once the house is sold just to pay for all of his debts. So when you walk away from a real estate transaction with no money or even a tax bill, you're in big trouble. And why is this a problem? It's a problem because this guy is just one example of someone who didn't want to sell. He wasn't expecting to sell his home right now, but he is forced to, guys. That is the number one thing you have to realize from this, is that he is being forced to sell his property because he is in a debt position that he can no longer satisfy. And you're gonna see a lot of people fall into this position. As the recession continues to get worse, more people lose their jobs, especially people who took risky adjustable rate mortgages a few years ago that are gonna be coming up for renewal soon. Those people are gonna be in the biggest trouble. And like in Canada, for example, it's very common for people to take out very short-term mortgages that are only 1 or 2 years over there, and they have variable interest rates. So now that a bunch of those are going to be coming up for renewal, people's teaser rates are over, they can't afford these new payments. And they're saying about 12% of borrowers in Canada have one of these very short-term adjustable rate mortgages. And how it works over there is the government has a stress test, since they do have a lot of short-term loans over there. The person who's buying a property needs to be put through a stress test to see if they can actually afford a higher mortgage rate when their rate resets. The problem is that these mortgages that are only 1 or 2 years, that reset every 1 or 2 years, are not subject to this rule. And therefore, you have 12% of the people there who have one of these that probably won't be able to pay when it resets in the next 12 months. And it doesn't end there either. There's another woman in Canada who was in Vancouver, and they couldn't afford to buy a place to live in. So her and her husband thought it was a good idea, like, hey, let's buy an investment property instead, because it's what we can afford. Even though it's not a good fit for our family, we can buy this rental. And they decided to move forward with the deal, even in a negative cash flow position. And when they first purchased the property, they were only losing $80 a month Canadian. But just like so many other people in Canada, these people also decided to get an adjustable rate loan, very short term, in order to get into the property, because their thought was, well, let's get into the property. Values are going up so fast here, we're going to build a ton of equity and just make a bunch of money that way, so we're not worried about losing the $80 a month. Well, guess what, guys? Fast forward to today, the interest rate has reset, and now instead of losing $80 a month, they're losing $500 per month on the same rental property. And can you imagine being a landlord and holding on to a rental property that you're losing $500 per month on? Does that sound like a good deal to you? Does that sound like a good investment? This is why I tell people on my channel constantly, if you're gonna buy real estate for investment, the numbers need to work from a cash flow point of view, guys. If the numbers don't work and the property does not have a significant amount of positive cash flow, walk away. Because if you don't, you end up like somebody like this. And even if you don't have an adjustable rate loan like these people do, you can have a 30-year fix on a property. And if you're operating on razor thin margins and your cash flow is just like 50 bucks a month, something ridiculous like that, all it takes is a property tax hike or one huge repair for the year, and now you're losing money each month on your property as well. So you don't want to be in this position. So people who thought they could just buy and ride up this wave and always have this endless amount of equity that they're going to earn on the property have now gotten the reality check that that's not going to happen, and the party's over, guys. So who knows if these people are going to lose their property also. Probably, I would say the average person probably can't afford to lose $500 a month for very long before someone like this is going to be forced to sell as well. So people are getting squeezed from all different angles right now when it comes to real estate. You know, you have people who are going through these adjustable rates right now that are getting the resets happen and they have to pay more. You're getting people getting property tax bills that are double. You're seeing interest rates for refinancing and purchases more than double than they were a year ago. On top of that, people are dealing with big inflation numbers, and that's why I think we're still going to see a very similar situation here in the US, even though we don't have nearly as many people that go for these variable rate mortgages. There's still a significant amount of people that do, and even people that have the vanilla 30-year rates, a lot of people live paycheck to paycheck, guys. Anyone who's living on razor thin margins, even with their own house, even though they have a 30-year rate, all it's gonna take is one layoff, one stupid little financial setback, and these people will be the next ones to be defaulting on their mortgages. So between the HELOC borrowers, the adjustable rate mortgage borrowers, the 30-year rate borrowers living on the edge, between all of these people, as we get deeper into this recession, I think you're going to start seeing the default rate on these loans start to go through the roof in 2023. Now, because it's the holidays and people really start ramping up their spending this time of year, especially on credit cards, I came across this very interesting story today about credit cards. And there was actually this in-person poll done back in 1969 from women at the supermarkets. And they were basically asking women how they felt about credit card usage when it came to buying groceries, because back then was right around the time when credit cards started becoming more popular and some grocery stores were starting to accept them as payment. Here's what some of the women said back in 1969, and I thought it would be interesting to take a look at this to see if what they thought about credit cards back then has any truth today. One woman said that credit cards will lead to people overspending. She says that I'm sure people will find the accumulated total of charges at the end of the month much harder to pay than if they would have just paid cash each time. Another woman, and remember guys, this is back in 1969, they were talking to these women. She said that you'll see this will end up as one of the biggest causes of voluntary bankruptcy. People won't be lining up at grocery store cash registers, but rather at the bankruptcy courts. Wow, listen to this one. She really saw the future. She said that, I think we're gonna come to a time when we won't handle any of our money at all. Some big computer will run us and our money. That is scary that she was thinking that far ahead back then, especially now. Just recently, the CBDC went live as an experiment, guys. I'm not going to get into all that in today's video, but this is bad news and we need to find ways to fight against this. But I'm not going to talk about that in today's video, but I just wanted to point out how right this woman was 50 years ago. And this is when this huge credit card problem started back then, because what they said in this article is that Back then, it was starting to become fashionable for people to buy a TV set, an oil burner, their car, their mink coat, and trips around the world on their credit cards and live it up and actually go into debt. The credit card basically poisoned people's minds back in this era and put people in a frame of mind where now I don't have to worry about how much I earn anymore because I have this opportunity to spend money that I don't have. And then you fast forward to times like today, and the Federal Reserve's most recent report pointed out that in the third quarter of 2022, we added $351 billion in overall debt, higher interest rate mortgages leading the way, but credit cards not far behind that. This is the fastest quarter that we've seen household debt rise in the US since 2008. Yet another correlation back to 2008, guys. And basically what this report says is that we have now added more debt than we have in the past 20 years, and the collective total credit card balance just from 2021 to 2022 has gone up by 15%. That is gigantic in just 1 year. If this doesn't scream help, if this doesn't scream recession to you, I don't know what will. Because when you add together these looming problems with people's mortgages and ability to pay right now, combine that with people just going head over heels into further credit card debt just to be able to get by, it's a complete recipe for disaster, guys. And you know what this is going to do? It's going to be just yet another driver of inflation. Why is that? Well, because people who actually don't have money, they go out and spend on things with the credit card and buy things they actually can't afford, when if they were forced to only pay cash for things or only be able to spend the money they actually have, that would help quell inflation a little bit quicker because people would not have the ability to go out and spend money that they don't have. So all this is going to do is make inflation worse. And you know what else is going to make inflation worse, guys? We already talked about wage increases in the service sector that's going to increase inflation. Now we have people going further into credit card debt that's going to make inflation worse. And the icing on the cake is going to be the most recent reason why inflation is going to continue going up. President Biden just extended the student loan payment again. They were supposed to be due at the end of this year, and because his proposal got struck down in the justice system, now he's going to try to take it to the Supreme Court and see if he can get the loan forgiveness approved the way he wanted to give people the $20,000 loan forgiveness. Well, since it didn't work out his way, he's able to actually extend the forgiveness even further. And basically this is how it's going to work from here on out. If they're not able to get their way and win this court case by June 30th of 2023, by the way, then finally the payments will resume 60 days after that, which would basically be the end of August, beginning of September 2023, guys. So almost a year from now. This is the 8th time that the student loan forgiveness has been extended. And you know what this is going to do? Just like our friend, the credit card debt, it's going to increase inflation. How, Michael? How will this do that? How will saving these poor people from their student loans a little bit longer increase inflation? Well, I'm glad you asked. I'll tell you how. It's exactly the same thing as the credit card scenario. You have people who owe money on these student loans that are not paying in the order of $300 to $500 per month right now for a lot of these borrowers. And what do you think they're going to do with that extra money, guys? You think they're going to save it? You think they're going to put it in their bank for a rainy day? No. They're not. You think they're going to put it towards their debt? No, they're not. What are they going to do with the money? They're going to spend it. They're going to spend it on vacations and travel. They're going to spend it on going out to the nightclubs and the bars and restaurants with their friends. They're going to spend it on Black Friday. They're going to spend it on Christmas presents. They're going to spend it on a new car. They're going to spend it on anything that they want to because they don't have to pay their bills. This is exactly like the rent moratoriums that we talked about that are still in place in LA, which is disgusting, by the way. And all this does, guys, is it makes inflation worse because it's another stimulus check in a way. You're giving somebody an additional $500 a month that they should not have to spend in the economy because they're not paying their bills. That money should be going towards paying their bills, but it's not. It's going towards whatever they feel like spending it on, which further increases inflation, because the more money people have to spend on goods and services, the worse inflation's going to get, and the more the Fed's going to have to increase their rates, which is going to end up tanking the economy even further. So, because of all these wonderful things that are happening, guys, welcome to the depression of 2023. That's where this is headed at this rate, because we have seen time and time again of all these different ways that the government is making inflation worse. Simultaneously, while the Fed is trying to fix the problem, the government's making it worse. And it seems like there's no end in sight in ways that they're looking to make it worse. And it's going to be one of the reasons why this is going to be the biggest crash we've probably ever seen in our lifetimes. You know, I wasn't really totally convinced of that before because there was so many what ifs, but now that we're starting to see all the chips fall, it's becoming extremely obvious that this is going to have to get way worse, guys, before it gets any better. And remember, even these students that do get some forgiveness, it's not going to be enough to take care of most people's balances, and they're still going to have to resume paying at some point in the future, which at that point they probably won't be able to afford to anymore. And those are going to be the people that bought homes and have new cars and all kinds of things like that that are going to be defaulted on, because now they actually have to start paying their bills again. If you guys enjoyed this video, make sure you click the bell notification down below. YouTube will alert you every time I have a new video out. And if you don't want to wait, check out my next video on the screen right over here, and I'll see you in the next one.